If today's plunge holds, it'll rank as one of the biggest daily percentage drops of all time, second only to the first day of Operation Desert Storm during the first Gulf War. Joining us right now to help us try to understand what this all means, Stephen Richardson is here, Evercore ISI's head of oil and gas exploration and production research. Good morning to you.
Morning.
Did you ever imagine we'd be at these levels this quickly?
It was certainly unforeseen. And I think that, positioning of the market probably suggested that.
So what does the washout look like?
The washout looks like we were already having a washout in high yield for a lot of this industry. Capital markets have been closed for some time. The washout will look like, at least in the domestic industry, is a wholesale pullback of activity amongst the U.S. producers. I mean, we're already seeing that from the industry. We've seen a couple of releases this morning of industries talking about protecting balance sheets, reducing activity. So our team was out this morning with talking about 30% reductions of capital in this industry, at least in the upstream in North America, 25% reduction in the rig count.
Right. And in terms of job losses, I mean, in terms of the trickle through the economy, how should we think about that?
Industry in terms of final consumption is around 6% of GDP. I'm personally of the view that the multiplier effect on some of the big energy producing states is pretty significant in terms of jobs, and so I think we're bracing for a wholesale pullback, at least in those areas: Texas, Oklahoma, North Dakota.
Is there any energy company that right now you'd actually want to own because you think there's an opportunity here?
I think it's too early. I just think, essentially, it's walking our clients through it this morning. It's more a question of valuations where people stop selling than it is valuations where people start buying. It's literally just trying to figure out where you hit a floor. Certainly, we know that this industry and certainly most of the producing nations don't work at $30 oil, and I think that was the logic that stuck in 2016, the last time we've had this. There are real differences this time, including the fact that demand is falling, and we still don't know. Many of the agencies were out with flat demand.
You're having conversations with your clients about where a bottom might be. What is it? How are you even trying to ascertain that?
I think to the extent that U.S. If you think about it this way, that if OPEC, if Saudi was out overnight talking about increasing production, and I think the logic is that if we need to ration somewhere around 10% of U.S. shale production, that's around 900,000 barrels, a million barrels. What price makes that happen? I think the mid-30s WTI is probably the right ballpark for that. Again, it's going to take time because this industry can't slow down fast enough in terms of rigs, wells, and all the activity that's been going on. But it will take time. But certainly, in a low 30s price, you will see U.S. oil production start to slow in the back part of this year and roll pretty hard in 2021. Obviously, that creates quite a bit of dislocation for the industry.